Welcome to Illuminati Silver. We tell you the truth about silver. Today is Saturday the 25th of April 2020, and we're publishing our gold and silver weekly update for the week ending the 24th of April. Gold rose $44 last week from $1,685 to $1,729, having hit a high of $1,769 and a low of $1,662. A rise of 2.6%. In sterling terms, gold finished the week at £1,397. That's up £50. And in euros, it closed at €1,597. That's up €49. Silver rose 7 cents from $15.21 to $15.28. Having hit a high of $15.47 and a low of $14.56, a rise of 0.44%. In sterling terms, it closed at £12.35. That's up 19 pence. And in euros, it closed at 14.12 euros. That's up 0.13 euros. The disparity shows once again the strength of the dollar versus sterling and the euro. The gold to silver ratio rose from 111 to 1 to 113 to 1. The Dow Jones closed on Friday at 23,775, up 260 points on the day, but down 465 points on the week. The S&P 500 closed at 2,836, up 38 points on the day, but down 38 points on the week. And the Nasdaq closed at 8,634, up 139 points on the day, but down 16 points on the week. So we're seeing a degree of consolidation here in the equity markets. Brent crude closed at $21.44, down $6.64 on the week, and WTI crude closed at $16.94. That's down $1.33 on the week. But of course, we all know that the previous contract closed well into negative territory for WTI crude. The dollar index stands at 100.38. That's up 0.60 points on the week, and breaking that much targeted 100 level. Now, we mentioned in last week's video podcast, referring to the previous week and then predicting moving forward from last Saturday, the following quote: "That said, we should not miss the fact that on Tuesday gold rose to a 7-year high, where technical analysts are now quoting 1747 as clear resistance. This represents the April highs. The 10-day moving average of 1685 is currently where gold appears to be consolidating and offering a degree of support, though there is stronger support at the 50-day EMA at the 1630 level. The technicals are painting a slightly negative picture in that short-term momentum has turned negative, with medium-term momentum remaining positive, suggesting a degree of consolidation. This could represent a good buying opportunity if one is light in gold and taking the view that gold will rise to $1,800 and possibly $2,000 this year, according to some, or by the end of next year, which is our most likely scenario. Silver tracked gold from Tuesday onwards, attempting to get through the $16 level, but failed. We've frequently stated that silver will have its day, but for the next few weeks, we envisage it will still lag gold. When industrial production begins to pick up, then we shall see silver decouple from gold, but we do not believe that time is yet." Unquote. So, since Tuesday's low, because gold did fall initially, it's been on the rise, reinforced yet again by another 4+ million added to the US jobless figures. There was certainly a degree of profit-taking by traders, but despite this, gold has closed at a weekly 7-year high. And this is important. As mentioned last week, the next resistance level is the April high of 1747. And if the $1,800 level should be breached, then the next major hurdle from a technical point of view will be its all-time dollar high of 1921. Now, the current technicals suggest short-term momentum has turned positive, as the fast stochastics generated a crossover buy signal in the middle of the neutral range. The RSI moved higher in tandem with price action, reflecting accelerating positive momentum. The MACD index stabilized and started to accelerate higher, which reflects accelerating medium-term momentum. All this appears positive. However, we shall come back to this in a moment. You may remember in last week's update, we stated that Thursday and Friday were the important data days, and this has proven to be the case. With Thursday's weekly jobless figures and Friday's durable goods orders figures for March, which incidentally showed a fall of minus 14, or rather a fall to minus 14.4%, compared with a positive 1.1% in February. This is the largest monthly fall since August 2014. It's important to bear in mind that gold suffered a degree of exhaustion on Friday. So we've got really positive technicals, but the reality is there was a degree of exhaustion. But the momentum is still up, and as we stated last week, pullback should be seen as an opportunity to buy for the short to medium term. Silver again struggled, as we also pointed out last week, reaching lower lows and lower highs than the previous week, though it did manage to close in positive territory. It certainly appears at present that $15 silver represents a core price level, with oscillations between $14.50 and $15.50. Like silver struggling, we're also struggling to convey the point to some of our listeners who've been totally brainwashed by the pumpers, that the message we're trying to give is that silver will continue to lag gold for some time yet some of you just totally refute it. You see, we don't care what the pumpers say about historic gold to silver ratios, or that the debt clock value of silver is trillions of dollars. Okay, we're exaggerating to make a point. The reality is, in the current state of economic decline, the only people buying silver are those doing so for monetary purposes. And that market is tiny compared to those buying gold for the same reasons. It's nothing to do with manipulation, though we do accept the paper traders dominate the price, but they do with all commodities. Now, you may not like that fact, but get over it. The only reason silver 1-ounce coins are $25 an ounce plus when the spot price is $10 lower is simply because of the temporary restrictions on transport and the limited ability of mints to produce because of the current government recommendations. Rest assured, if we did not have this global issue arising, silver would probably be trading today between $10 to $12 an ounce, rather than the current $15 to $16. Now, it's only if we were to see a major or total financial collapse, with gold then shooting to $3,000 or $5,000, or we see industrial output beginning to pick up again because economic decline has ceased and we start to see gradual rises in industrial output, only then will we see the genuine price of silver begin to rise to those levels and beyond that some of you are being panicked into buying right now. We know that some of you believe that silver, even at $25 an ounce, is the lowest it will ever be in the future. We do not share that view. You may not agree with our prediction, but let's revisit this in, say, 6 months' time and see. Yes, long term, current prices are a steal. But we would rather have a steal at $15 to $18 than a steal at $25 to $30 an ounce. The frustrating thing for us, though, is even when we're proven right, as we have been in most years, not all but most, Some of you will still gravitate towards the pumpers because they are providing you with the messages you want to hear, as opposed to the messages that you should or need to hear. Oh well, such is life. Fantasy is undoubtedly far more attractive than reality. So let's now take a look at this week's US economic news to be announced. On Monday, there is nothing scheduled, but on Tuesday, we have advanced trading goods for March and the Consumer Confidence Index for April. Wednesday, GDP for quarter one. Now, the forecast for that is minus 3.3% compared with a plus 2.1% for quarter four of last year. FOMC announcement on interest rates and Jerome Powell's press briefing afterwards will also be made public on Wednesday. Thursday, weekly jobless claims, personal income for March, consumer spending for March, and core inflation for March. And on Friday, we have the market manufacturing PMI for April, the ISM manufacturing index for April, and motor vehicle sales for April, the annual rate of motor vehicle sales. So really important data from Tuesday onwards. And we should see some quite interesting moves in equities, the dollar, and gold and silver prices this coming week. So it's certainly a week to watch. Now again, and forgive the repetition, we're still more positive gold than we are silver. But if the figures are much worse than anticipated this week, then both of them should rise because the monetary demand for both should increase. However, if those figures meet expectations, which admittedly will be negative expectations, but if they were to just about meet those or fall short of them, then there may be a slight pullback in gold and silver prices. But we're the first to admit if that does occur, then once again a good buying opportunity may present itself for those of you who feel you have to still get in on the gold and silver action. Now, as we have said so often, we are bullish precious metals for this decade. But it won't be a straight line up or down, but gradual builds, with some declines interceding. As long as your focus is on the medium to long term, in our assessment you cannot go wrong. But please do not pump in your entire wealth with a view to making a quick buck, as the odds are you will be sorely disappointed. What do you think? Do share your thoughts. Thank you for listening. And if you haven't already done so, please subscribe to our channel and press the bell sign so that you're notified of our videos as and when they're published, not forgetting hopefully to do the same on our Richard and Greg channel. We trust and hope that you have both an enjoyable and safe weekend as well as the week ahead. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.